Most traders have very poor results when trying to predict market direction. To many, it feels like the market is secretly against you because it seems to do the exact opposite of what you think will happen. Look, we've all felt this way at times. But trading directionally is only one way to play the game. Another way, and perhaps a better way for some, is to be a non-directional trader and deploy the power of certain option strategies to make money whether the market goes up or down. In this video, our head of options trading will teach you one of these powerful strategies. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to have developed numerous 7 and even 8-figure per year traders. We hope you agree this is the top YouTube channel to help you grow your trading account.
Hi everybody, I'm Seth Freuberg and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And earlier this week, I flew to Las Vegas to speak at the Money Show in Las Vegas. I presented a speech called The Secret to High Probability Options Trading. And for those of you who aren't able to make it to the Money Show, I thought it'd be interesting if we were to share with you that talk because the attendees thought it was pretty valuable. So let's get into it. All right, so let's talk about what we're going to be going over today. And in this workshop that we're going to be conducting, you're going to discover the reason why you don't have to risk your own capital to trade for a living. Most people believe they've got to use simply their account and their savings to trade, but there's another way. We're going to share that with you. We're going to be talking about why most professional options traders trade broad-based index options, not stock options. There's a lot of important reasons. We're going to be going over that. We're going to be talking about why it actually makes more sense to sell options than to buy them. We're going to next discuss how to set up trades with an 85% chance of winning statistically. Most importantly, we're going to be going over why you never have to pick market direction to execute high probability trades with a really high win rate. So that's what we're going to be going over today, and let's dig into it. So first of all, I'd like to share with you who SMB Capital is. We're not just another trading education guru. SMB Capital is a proprietary trading firm, and we're located in Manhattan. And we're one of the best known and most respected professional trading firms in the world. Here's a sense of what our headquarters look like, and you can even hear the ambulances in the background here in Manhattan, where we're shooting this video today. SMB Capital is home to 65 plus pro traders. And so education is not really our main business. Our main business is producing hundreds of millions of dollars of trading profits in-house. We have truly elite 7 and 8-figure traders who trade for SMB Capital, who trained here and are now extremely successful. And trading, therefore, is our lifeblood. This is mainly what we do. The partners of our firm have appeared on CNBC, CNN Money, BBC, Bloomberg, etc., and Wall Street Warriors. We are well known throughout the financial world. So what's the good news? And the good news is that you don't always have to simply trade your own capital to succeed as a trader. Proprietary trading firms do not require you to put up any capital to trade for them. Instead, the prop firm puts up 100% of the capital, and the firm takes 100% of the risk. Professional prop firms then shares with you a generous percentage of the profits you make each month, but we do not ask you to take part in any losses. But for the privilege of you trading our capital, obviously you've got to be a qualified trader, you've got to be profitable, you've got to be consistent, and most importantly, you have to be disciplined and careful. I'm Seth Freuberg. I'm the head options trader here. I first learned to trade options after 20 years as the CEO of a property and casualty insurance company. The traders on our desk are not just kids, right? You think of most traders as young people, but in fact, many of the traders on our desk traditionally have been obviously young people in their 20s and 30s, but plenty of people in their 40s, their 50s, even their 60s. They're from all over the world, and they can trade remotely or in our offices here in Manhattan. We have plenty of traders all over the United States, in Europe, in Asia, even Australia. All right, so I promised to talk a little bit about index options and why professional traders who are options income traders tend to trade index options versus individual equity options. So let's talk about that. Most people know what equity options are. For example, if you buy an equity call option, then you're entitled to buy 100 shares of the stock to which that call is derived at any time between the time you buy that option and the time it expires at what's called the strike price of the option. And we'll give you some examples here in a minute. An equity put option, on the other hand, confers the right of the buyer of the put option to take shares he owns and sell them, 100 shares in particular, at the strike price of that put option. Index options, on the other hand, settle in cash. Why? You can't own an index. You can't own 100 shares of an index because an index is a measurement of a basket of stocks. But index options, therefore, do not pay off in shares, do not provide a right to buy or sell shares, but rather index options provide you the opportunity to receive cash in your account, and therefore index options are cash settled. And you'll see examples of this in a moment. An index call option pays you exactly $100 for every point above the strike price of that option on expiration day. An index put option pays out $100 for every point below that strike price. What most people may not be aware of is that you can buy options, but you can also sell them. Your broker will allow you to do either. So when you buy an index option, you pay cash for it, and you are called long that option. But when you sell an index option, you receive cash. You're short that option. So if you're long an index call option, you want the market to go up. If you're short an index call option, you want the market to go down. If you're long an index put option, you want the market to go down. And if you're short an index put option, you actually want the market to go up. So your broker is going to allow you to buy or sell them. And whether you've bought or sold them dictates what you want to happen in the market. And when you buy an index option, you pay $100 times its quoted price. So for example, if you buy this 4130 strike price call that you can see on the illustration here, the quoted price is $68.45. Well, you pay $100 times that. So you pay $6,845. Same concept with the put. If you buy the put, the 4130 put, you see that the price is $57.95, where you multiply that by 100, and what actually comes out of your account is $5,795. All right, so that's buying an option. Let's now look at how options are settled. For example, let's say you own the 4,000 strike price call. All right, you bought that. And the index in question, just whatever index it may be, closed at 4,032. Well, the way you're going to calculate how much that call option is worth is you take the closing price, 40.32, you subtract from it 4,000, that brings you 32, you multiply that by 100, and that gets you to $3,200. The 40.75 strike price call, however, expires worthless, and the one who sold that call to you pockets the premium. He wins that transaction. And the reason is because the 40.75 call was well above where the index closed on expiration day. And so owning that call brought you in nothing, and you had a value of zero on your hands at the end. All right. Same thing with the final value of the puts. Take the same index. It closes at 40.32 on expiration day. The 40.75 strike price put pays out the strike price minus the closing price of the stock, because remember, these only have value when the market closes below their strike price. That gives you 43. You multiply that by 100, and the option is worth $4,300 on expiration day. But the 4,000 strike price put, that one expires worthless. Why? Because the market did not close below 4,000, and therefore, again, in this example, the put seller wins, because he didn't have to pay out anything from the put contract that he sold. Instead, he just gets to keep the cash that you paid him when you bought that from him. So that is how index options are valued. So now we need to focus on options premiums and break-evens. You see, every option has a premium that's built into it to compensate the seller of the option for the risk that that option seller is taking. So if an index is trading at 1200, for example, and let's say that the 30-day at the money call might be trading for $25, which you pay $2,500 for, as we just told you. So for the buyer of that call to make money, the index has to get up to 1225 for the buyer to break even on the call, right? You pay $25 for it. It won't pay off until the market goes above 1200. If it does, it's got to get past 1200 by $25 in order for you to make any money at all, because you spent $25 on that call. Now, the seller of that option makes money at any price from 1225 or below, right? Let's say the index closes at 1224. All right. Well, the seller was paid $25 for selling that option. The index closed at 1224. So even though the call option is worth $2,400, the one who sold it only has to pay out that $2,400. He gets to keep the $100 that he collected net of the $2,400 he paid out. In other words, he collected $2,500. He has to pay out $2,400, so he makes $100. And that's why at any price below $12.25, the option seller would make money in this case. So the call buyer doesn't have to just be right that the market's going to go up. If you don't think the market's going to go up, don't buy a call option. If you do think it's going to go up, you can be right, but you've got to be right enough to cover the premium that you paid in order to make any money on the trade. So you can be right about the market's direction and still lose money buying an option. Being long on an option, you have a hurdle to overcome, which is the premium you initially paid for it. In this case, was $25. So you're right. The market went from 1200 to 1224, and your thanks for being right is you still lose money. The call seller, of course, who wants the index to go down because he doesn't want to have to pay out anything on his obligation, he can make money even if the market goes up a little bit. So now you're the call seller. The market goes up. It gets to 1215 and stops. You make the entire premium. You just get to pocket that premium. If you think about it, the true edge in options trading is in selling options, not buying them. Think about it. There's only 5 possible incomes for each index option trade, right? The index rallies a lot. The index rallies a little. The index doesn't move at all. The index goes down a little bit, or the index goes down a lot. I think we can all agree those are the only 5 possible outcomes of an index options trade once you've entered into it. So for example, if you buy an at-the-money call option, you actually lose in 4 out of the 5 cases. Why do I say that? Well, if you buy an at-the-money call option with a strike price of $1,900 for an index trading, at $1,900, and you pay $40 for that, which means you're going to actually have a cash outflow of $4,000. Then, if the index goes down a lot, you're obviously going to lose because the call is only going to respond at all if the index gets up above 1900. Okay. The second case, the index goes down a little. Again, you're going to lose, right? It has no value unless it gets above 1900. Suppose the index doesn't move at all; it just stays at 1900. You're going to lose. Suppose the index goes up to $39.99. Remember, you paid $40 for it. So if the index goes up $39.99 to $1939.99, you still lose. You lose $1, but you still lose, right? So you were right and you lost. Only if the index rallies more than $40, which is the cost of the call, in that one case, you win. But what if you are the seller of that same call? I want you to think about the situation you have. If the index goes down a lot, you win, right? It will be below 1900. It has no value on expiration day. The index goes down a little bit. You win for the same reason. The index doesn't move at all. You win. The index goes up as much as $39.99. You win. Only if the index rallies more than $40, the cost of the call, only in that one case, do you lose. So you can see your chances of winning by selling an option are always going to be better than buying it because in 4 out of the 5 scenarios you're going to win. All of options income trading is based on this wonderful edge. When you sell an option, you get paid for entering into a trade where 4 out of the 5 scenarios you will win. So the strategy that we're about to teach you is based on this one basic fact. Most options contracts expire worthless, and the seller of the option pockets $100 of the premium you paid him. The purpose of this workshop is to teach you how to be an options premium seller, the smart place to be in options trading. So let's take a look at a great example of this kind of trade. A good way to summarize the trade we're about to teach you is how to win over a huge range of prices, whether the market goes up, down, or nowhere. This is a chart of the SPX index on December 15th, 2022. And many of you may not have realized this because you may not look at things the way options traders do. But the market, the SPX index, the S&P 500 index, actually channeled in a fairly definable range in the last 8 months of 2022. You see that range that we're showing you there? It channeled between 3,500 and 4,300 over the 8-month period from May through to mid-December. And so let's say that you decided you wanted to put on a trade which gave you a very wide range of price outcomes over which you would make very decent money. So let's say that you as a trader initiate an 850-point wide iron condor options trade. And we'll get into later why I'm saying that's an 850-point wide iron condor trade. Basically, what we're doing is we're bracketing the market around its 8-month lows and highs. And we're doing so by going forward about 60 days to the February 17th options chain, which expires in 64 days. So how we'd construct this trade is we would sell 10 index option calls on the S&P 500 index, the SPX index, up at 43.50. And at the same time, we'd sell 10 puts at the $3,500 price. So basically, we've bracketed that range that the market was trading in over the last 8 months. 3,500 was support and 4,300 was resistance. And so at the same exact time, for protection and to be careful, we're buying 10 calls 25 points higher than the 43.50s we sold. Those are at 43.75. And we also bought 10 calls 25 points lower at 34.75. So we actually execute these all at once. This is called an iron condor. Your broker, if you have any of the major brokers, will have an options platform that will have on its menu of options choices, option strategy choices. One of those menu items will be an iron condor, and you simply populate it with the strike prices and the lot sizes that you're interested in trading. Let's take a look at the cash flow of what we just did. It's very important to understand the cash flow. So when we sold those 43.50 calls, we received the price of $15.20 for those. But remember, you have to multiply that by 100, and we sold 10 of them. So that produces $15,200 in positive cash flow into our account. When we sold the puts, we also had a positive cash flow event. This time we received $23.20 for it. We multiply that by 100, and we sold 10 of them. So we multiply that by 10, and we get in for that part $23,200 in cash right into our account. Now, we're going to spend some of that now. We're going to spend a lot of it because we are going to be careful traders and we're going to get some protection. So up at 43.75, we're going to buy those 10 calls, as we talked about. $12.70 is the price we've got to pay for those. Again, you multiply it by 100 and again by 10 because we have 10 lots. That is a cost to us of $12,007. So that's coming out of that cash that we received by selling the calls and the puts initially. And then at the same time, we're also buying the protection on the puts, buying those 34.75 puts, and those fetch the price of $20.95. And so that cost us $20,950. So when you net it all down, there's a positive cash flow of $4,750 coming from entering into this iron condor. And your broker will require you to have $20,250 in your account to do this trade. So just to recap, through selling and buying a combination of options, you've got positive cash flow in the amount of $4,750. You will see the cash in your account go up by $4,750, but then your broker is going to require you to have $20,250 in your account in order to do this trade, which is also the worst case scenario of the trade, by the way. Let's move to February 7th, 2023. And you can see that the index has closed at 40.79 on the day that the options expired. So all of the options expired with zero value. That's right. Every option that we entered into had zero value at the end of the day. Why? Remember, calls only have value if the market closes above their strike prices. Puts only have value if the market closes below their strike prices. Well, the SPX index closed at 40.79 between the calls and the puts. Let's break this down so you really understand what I'm talking about here. How are we going to value each of these options at expiration when the SPX index closed at 40.79? Well, let's look at the calls first. Remember, we were short the 43.50 calls and we were long the 43.75 calls. Well, the market closed at 40.77. Does a call have any value if the market closes on the day it expires below the strike price of that call? And the answer is no, it has no value. So the ones we were short and the ones we were long both expired with no value. And the same thing happened on the put side with SPX closing at 40.79. Both the 3,500 puts, which are way below 40.77, and of course the 34.75 puts, which are below that, both of them expired worthless because they only have value if the market expires below their strike prices. Well, the market expired way above their strike prices at 40.79, and therefore none of them expired with any value at all. Every option that was part of that iron condor expired with zero value. What's the profit on the trade? Well, SPX closed at 40.79. So we just showed you the calls, the long calls at 43.75, the short calls at 43.50, the short puts at 3,400, and the long puts at 34.75. All of them, for different reasons, expired absolutely worthless, meaning that $4,750 that we received at the beginning of the trade, we just pocket that, okay? And that provides you with a profit, in this example, of over 23% on the capital that was required on the trade, that $20,250 we talked about a little bit earlier, all right? So simply because all the options that we entered into in this iron condor expired worthless, the only thing left is for us to pocket that $4,750, which means the guy who bought the iron condor from us, he lost that $4,750, just as we described with outright just buying and selling calls. It shouldn't really be that surprising that an iron condor, where at any price within an 850 point range, we win, right? Because as long as the market was anywhere between the short put at 3,500 and the short call at 43.50, anywhere between those two prices, which is 850 points, we were going to win on that trade. And it was no accident that we set it up so that the short put was at support and the short call was near resistance. Why? Because the market had shown a willingness to channel in between those 2 points during the previous 8 months. So we were betting that the market was going to stay somewhere within those 850 points over the next 60 days. And statisticians would tell us that the chances of it doing that, of just staying inside that range, are about 85%. And so with those kinds of odds, most serious professional options income traders trade broad-based index options strategies. And they use, for example, the S&P 500 index called the SPX, the NASDAQ 100 called the NDX, or the RUT, which stands for the Russell 2000 index. And the reason is pretty simple. Options income trading is the only style of trading where you want the market not to move. And so index options are the ultimate in diversification, right? Why are they the ultimate in diversification? Well, no single industry can cause the price of the whole index to go wacko, right? No single industry can do that because there are so many industries represented. No single company's fortunes can go wacko and destroy a trade stability. No single company's event, such as an earnings report, a sales report, etc., can destabilize the index's price. And you have multiple expirations in a week for most major indices, okay? It used to be in the old days that options only expired once a month. So any strategy that you were to implement would only be able to be implemented 12 times a year. You only get 12 bites at the apple in the old days. These days, there's an index, the SPX index, that has daily expiration, meaning given that there are about 250 trading days in a year, you get 250 bites at the apple. Also, index options are very liquid and the fills are generally very easy and efficient. Another point I want to make, which I can't make to you in a direct way because I'm not a tax professional, but I urge you to ask your tax accountant about the tax advantages of trading broad-based index options, and I think you're going to be pleasantly surprised by that as well. So, options traders, what do? What do options income traders do? What they do is they figure out high probability trading strategies such as the Iron Condor, they backtest them, and then trade them with live capital every month, every week, and in some cases every day. In other words, they take high probability trades and they keep trading them over and over and over and over again because the probabilities of winning them are so high. Additionally, there are going to be cases where the market does something unexpected. It's within those 15% of the chances. If you have a high probability Iron Condor that you have an 85% chance of winning, well, there's a 50% chance you lose it. And of course, sometimes the market goes outside of the ranges of, for example, an Iron Condor, right? Well, they don't just sit there like sitting ducks. Professional options income traders have techniques for extending the size of the range so that hopefully the market will fall inside the extended range, even if it did not stay within the original intended range. And that's why we hire professional income traders for our desk and provide them with capital, because we know that this trading style works. If you want to learn more about options income strategies, we actually have a free 2-hour workshop that we would like to invite you to. You can register for that workshop at optionsclass.com. In that workshop, we're going to be teaching you 2 more option strategies, including a cool trick for getting paid while you wait to buy a stock at the price that you dictate. And we also teach you a second strategy where you can set a direction for a stock, put on an options trade on that stock, and even if you're outright wrong on direction, you still have a wonderful opportunity to make money on that strategy. So we're going to be teaching you both of those strategies in the optionsclass.com workshop. So go to optionsclass.com, register for that workshop, and learn 2 more option strategies.
Okay, so Iron Condors are powerful, but so are covered calls. If you trade covered calls or want to know how, check out this video appearing on your screen right now, which teaches you how to triple your income from covered calls with just a simple tweak. Click on the video to watch it right now.